In the 1840s, Britain believed railways would reshape the future. Parliament approved them, banks financed them, newspapers praised them. Thousands of miles of track were promised, fortunes were invested, entire towns speculated. Share prices doubled, then tripled, but many of those railways were never built. This was not just over-optimism, it was an infrastructure scam fueled by speculation, political approval, and financial illusion. When the bubble burst, investors were ruined, banks collapsed, and Britain entered financial crisis. This was Railway Mania. By the early 1840s, Britain was the most industrialized nation in the world. The Industrial Revolution had already transformed coal, iron, and textile production. Urban populations expanded rapidly as factories concentrated labor in major cities. Industrial output required faster transport between mines, ports, and manufacturing centers. Canals and horse-drawn wagons were no longer sufficient for the scale of growth. Railways appeared to solve a structural bottleneck in the British economy. In 1830, the Liverpool and Manchester Railway opened as the first fully operational intercity passenger and freight line. It demonstrated that steam locomotion could move both goods and people at unprecedented speed. Passenger numbers exceeded early projections within its first years of operation. Freight movement became more predictable and less dependent on weather conditions. Investors in that line received tangible returns supported by real traffic and revenue. By the late 1830s, additional major routes were completed, including the London and Birmingham Railway in 1838. These early lines connected industrial regions to ports and commercial hubs. They reduced transport costs for coal and manufactured goods. They shortened travel times between cities from days to hours. Railway companies paid dividends that appeared stable and repeatable. The success created a measurable track record rather than a theoretical promise. By 1843, Britain was recovering from an economic slowdown earlier in the decade. Interest rates were relatively moderate, encouraging capital deployment. Savings accumulated during earlier industrial expansion were seeking opportunity. Railways appeared to combine technological progress with financial return. Public discourse framed railway construction as national modernization. Investing in railways was portrayed as participation in Britain's industrial future. The assumption formed that demand for transport would continue rising indefinitely. Geographic expansion was interpreted as guaranteed revenue growth. The distinction between successful trunk lines and speculative regional routes was rarely examined. Early profitability created a belief that railways were inherently safe investments. This belief provided the foundation on which the later speculation would build. By 1844, railway expansion had shifted from measured development to accelerated promotion. The success of early trunk lines created the assumption that every proposed route would generate profit. Promoters began forming new railway companies at an increasing pace. Each company required a private bill to be submitted to Parliament for authorization. In 1845, the number of proposals surged dramatically. More than 1,000 railway schemes were presented for parliamentary consideration in that single year. These schemes proposed over 20,000 miles of new track. At the time, Britain operated fewer than 2,500 miles of active railway. The scale of proposed expansion exceeded practical demand. Prospectuses circulated widely across London and provincial towns. They projected rising passenger numbers and expanding freight volumes. Revenue forecasts assumed continuous economic growth. Few projections accounted for competition from parallel routes. Multiple lines were proposed between the same industrial cities. Some towns with modest populations were promised several competing railway connections. Engineering surveys were often preliminary. Cost estimates were frequently understated to attract subscribers. Share offerings were structured to require only small deposits at the time of subscription. This lowered the financial barrier for entry. Clerks, shopkeepers, landowners, and professionals subscribed to shares. Women and widows invested savings through intermediaries. Railway shares became accessible to broad segments of the middle class. Newspapers amplified the opportunity. Financial columns published subscription deadlines and reported rapid oversubscription. Editorial commentary framed railway investment as participation in national progress. Public meetings were held to promote local lines. Speakers emphasized employment, property value increases, and commercial expansion. Speculation expanded beyond London into regional markets. In 1845, railway share prices began rising rapidly after parliamentary announcements. Oversubscribed offerings created the impression of scarcity. Investors purchased shares not only for dividends, but for resale at higher prices. Paper profits accumulated before construction began. The expectation formed that parliamentary approval guaranteed eventual success. Demand for shares became detached from underlying feasibility. Scale replaced scrutiny. The mania was no longer about transport efficiency. It became about capturing early entry into the next authorized line. By the end of 1845, capital commitments on paper reached levels that exceeded the available liquidity of many investors. The expansion appeared limitless. The financial structure beneath it was not. Railway construction in Britain required formal approval from Parliament. No company could build a line without securing a private act. Each proposal was submitted as a separate railway bill. These bills included route maps, projected costs, and expected revenue statements. Parliamentary committees were assigned to review them. By 1844, the volume of railway bills began to strain the legislative process. In 1845, the number increased dramatically. Hundreds of separate railway bills were introduced in a single session. Committees were required to examine engineering plans, land rights, and financial projections. The workload exceeded practical scrutiny capacity. Hearings were often brief. Opposing evidence from landowners or rival companies was limited by time. Engineering feasibility was not subjected to rigorous independent verification. Revenue projections were largely accepted as presented. Between 1844 and 1846, Parliament approved hundreds of railway schemes. In 1846 alone, more than 270 railway bills received royal assent. Approval granted companies compulsory purchase rights over land. It allowed them to issue shares legally to the public. It signaled that the state had sanctioned the project. Investors interpreted this approval as confirmation of viability. The distinction between legal authorization and economic feasibility was blurred. Many members of Parliament held railway shares. Some invested in lines they later voted to approve. Promoters lobbied MPs directly. Political influence shaped outcomes. Public perception equated parliamentary approval with safety. A railway with an Act of Parliament appeared secure. The legislative process unintentionally created moral hazard. Risk assessment shifted from investors to government procedure. If Parliament had approved it, it was assumed to be legitimate. The scale of approval accelerated speculation. Each new act reinforced confidence in the entire sector. Authorization became a marketing tool. The system meant to regulate expansion, instead amplified it. Legitimacy replaced scrutiny. Government endorsement became the foundation of financial illusion. Railway companies financed expansion through a structured share subscription model. Investors were not required to pay the full value of a share at the time of purchase. A small deposit secured the allocation. Future payments, known as calls, would be demanded as construction progressed. This structure reduced the initial capital required to participate. Speculators could control large share positions with limited immediate cash. As parliamentary approvals increased in 1845, demand for shares accelerated. New issues were frequently oversubscribed. Oversubscription created the perception of scarcity. Shares began trading above their original issue price. Premiums developed before a single mile of track was laid. Secondary market trading intensified in London and regional exchanges. Investors purchased shares with the intention of reselling quickly. Paper gains accumulated within weeks. Railway shares doubled in some cases. Others tripled within months of authorization. Rising prices reinforced confidence. Early investors showcased profits to attract additional subscribers. Newspapers reported strong subscription levels and price increases. Financial columns rarely examined long-term cost structures. The installment payment system delayed financial pressure. Shareholders believed rising prices would allow them to sell before future calls were due. This assumption depended on continuous market liquidity. Middle-class investors increased their exposure. Clerks and professionals committed savings beyond their annual income. Some investors subscribed to multiple lines simultaneously. Obligations accumulated quietly. Market valuation became detached from construction progress. Routes were valued on projected traffic rather than confirmed demand. Competition between parallel lines was ignored in price calculations. Land acquisition costs were underestimated. Engineering difficulties were not reflected in share prices. The focus shifted from operating dividends to capital appreciation. Railway shares functioned as speculative instruments rather than infrastructure investments. By late 1845, nominal market value far exceeded the capital actually paid in. The expansion was financed largely by expectation. Price momentum replaced fundamental evaluation. Paper wealth expanded faster than physical construction. The system rewarded early entry and rapid resale. It penalized those who remained when calls became due. Behind the rising share prices, engineering realities were less certain. Many proposed routes were surveyed rapidly to meet parliamentary deadlines. Surveyors often worked under compressed timelines. Topographical challenges were underestimated. Bridges, tunnels, and embankments were simplified in early cost projections. Land acquisition costs were frequently minimized in prospectuses. Compensation to landowners later exceeded original estimates. Passenger forecasts were often extrapolated from the most successful trunk lines. Traffic assumptions ignored population density differences. Small towns were projected to generate metropolitan-level demand. Freight estimates assumed continuous industrial expansion. Competing routes between identical destinations were authorized. Parallel lines divided the same projected passenger base. Some regions were promised multiple railways within short distance of one another. Projected revenue did not adjust for duplication. Construction costs escalated as iron prices fluctuated. Skilled labor shortages increased wage pressure. Imported materials required additional transport expenditure. Initial capital requirements proved insufficient for many schemes. Companies returned to shareholders with revised cost estimates. Some directors understated new projections to maintain market confidence. Engineering reports were not always independently verified. Optimism replaced structural feasibility analysis. Speculative enthusiasm reduced tolerance for caution. Investors focused on share price movement rather than route viability. Few examined long-term operating ratios. Operating expenses were frequently omitted from promotional summaries. Interest obligations on borrowed capital were not fully integrated into projections. Completion timelines were unrealistic. Delays increased financing costs. Incomplete sections generated no revenue. By 1846, the gap between projected profitability and probable performance widened. Some lines were geographically redundant from inception. Others required passenger volumes that had never existed. The illusion of universal profitability began to diverge from engineering fact. Many of the authorized railways were financially impossible before construction fully began. By late 1846, the structure that had driven Railway Mania began to strain. The installment payment model required shareholders to meet periodic capital calls. Initial deposits had been small. Future obligations were significantly larger. As construction advanced, companies demanded additional payments. Many investors had subscribed to multiple railway schemes simultaneously. Their total liabilities exceeded the cash they possessed. Rising share prices had delayed this pressure. Investors assumed they could sell shares before calls became due. By the end of 1846, market conditions shifted. New share issues saturated available capital. Liquidity tightened across financial markets. The Bank of England began raising interest rates in response to monetary pressures. Discount rates increased from previously moderate levels. Higher borrowing costs reduced speculative appetite. Credit became less accessible to smaller investors. Some shareholders failed to meet installment demands. Directors issued formal notices requiring payment within fixed periods. Defaults increased. Companies faced shortfalls in expected capital inflows. Construction slowed on partially completed lines. Borrowing was used to bridge funding gaps. Short-term debt accumulated. Banks grew cautious in extending further credit. Collateral values declined as railway share prices softened. The paper wealth created during 1845 began to contract. Investors who had leveraged positions were exposed. Share transfers became more difficult. The assumption of continuous resale opportunities weakened. By early 1847, unpaid calls mounted across multiple companies. Confidence deteriorated gradually rather than instantly. The structure depended on uninterrupted capital flow. When liquidity tightened, the financing model failed. The railway expansion had been funded largely by expectation. Expectation required rising prices. Without price momentum, obligations surfaced. The capital illusion began to dissolve. By early 1847, the railway market could no longer sustain its previous valuations. Share prices began to decline across multiple lines. The fall was gradual at first. Investors assumed the correction would be temporary. Capital calls continued to be issued by railway companies. Many shareholders were already financially stretched. Falling prices reduced their ability to resell shares at profit. Secondary market demand weakened. Speculative buyers became cautious. Liquidity contracted further. Unpaid installment obligations accumulated. Companies that depended on continuous inflows faced immediate strain. Construction slowed on numerous projects. Some lines suspended work entirely. Contractors were left with unpaid invoices. Suppliers tightened credit to railway companies. Confidence began to erode across the sector. By mid-1847, railway share values had dropped significantly from their 1845 peaks. Several prominent companies experienced sharp price collapses. Margin-based speculation amplified losses. Investors who had borrowed to finance subscriptions were exposed. Forced selling accelerated the decline. Banks holding railway shares as collateral reassessed asset values. Credit conditions tightened further. In October 1847, a broader financial crisis intensified the collapse. The failure of major commercial houses reduced market confidence. Bank failures occurred in regional centers. The Bank of England faced pressure on its reserves. Parliament suspended the Bank Charter Act temporarily in October 1847 to stabilize liquidity. The intervention reflected systemic stress. Railway companies that had not secured full capital were unable to proceed. Projects authorized only 2 years earlier were abandoned. Incomplete embankments and half-built bridges remained across the countryside. Thousands of investors saw paper wealth evaporate. Middle-class savings were significantly reduced. Bankruptcies increased among smaller shareholders. The railway network that survived was smaller than the one promised. The bubble had fully burst. Railway Mania ended not with a single event, but with structural exhaustion.
The collapse of Railway Mania extended beyond the stock exchange. Losses were concentrated among the expanding middle class. Clerks, shopkeepers, professionals, and small landowners had subscribed heavily during 1845. Many had committed savings accumulated over years of work. Installment obligations continued even as share prices declined. Some investors were legally bound to complete payments on depreciated assets. Bankruptcy proceedings increased during 1847 and 1848. Personal insolvencies became more visible in provincial towns. Credit networks that relied on investor liquidity contracted. Local banks exposed to railway shares faced balance sheet strain. Several regional financial institutions failed. Confidence in speculative investment weakened temporarily. Consumer spending slowed in affected communities. Construction employment declined as projects halted. Ironworks and suppliers experienced reduced orders. Contractors dependent on railway expansion faced cash shortages. Property values in towns expecting railway growth stagnated. Projected commercial expansion did not materialize. Political backlash emerged in public debate. Criticism focused on parliamentary approval practices. Questions were raised about conflicts of interest among members of Parliament. Newspapers that had previously promoted railway investment adjusted their tone. Some editorials began emphasizing caution in future speculation. The perception of guaranteed infrastructure profit was damaged. However, not all railway investment failed. Major trunk lines remained operational and continued generating revenue. The surviving network still transformed transport efficiency. Freight capacity expanded on completed routes. Passenger mobility improved permanently. The technological foundation was not invalidated. The financial structure surrounding expansion had been flawed. The economic slowdown of 1847 reinforced the contraction. Recovery required consolidation rather than expansion. Weaker railway companies were absorbed by stronger operators in subsequent years. The social impact was uneven but measurable. Railway Mania demonstrated that infrastructure enthusiasm could destabilize household finance. The consequences were borne by those who entered late and lacked liquidity.
The collapse of Railway Mania did not affect all participants equally. While many investors suffered losses, some individuals exited with substantial profit. Early promoters often retained founder allocations at favorable terms. They sold portions of their shares during peak market enthusiasm in 1845. Premium pricing allowed them to realize gains before construction risks materialized. Directors frequently received compensation in shares rather than cash. These shares were sometimes sold prior to large capital calls. Engineering contractors secured lucrative construction agreements. Payments were structured on progress milestones rather than long-term profitability. Suppliers of iron, timber, and equipment benefited during the expansion phase. Landowners near proposed routes often negotiated advantageous compensation. Speculative land purchases occurred in advance of expected railway approval. Some insiders anticipated parliamentary outcomes before public announcements. Political relationships provided informational advantages. Members of Parliament with railway holdings could benefit from approval cycles. Lobbying activity intensified during the peak authorization period. Financial newspapers played a role in amplifying optimism. Advertising revenue from railway prospectuses increased during the boom. Critical examination of cost assumptions was limited. The structure rewarded early entry and rapid resale. It penalized investors who relied on long-term dividend expectations. The installment model magnified this imbalance. Those who sold before capital calls preserved liquidity. Those who remained were obligated to meet rising demands.
Timing determined outcome more than operational performance. Railway Mania followed a distribution pattern common in speculative cycles. Risk was transferred progressively from promoters to later subscribers. By the time construction realities emerged, early sellers had exited. Losses concentrated among less informed participants. Legal accountability for over-optimistic projections was limited. Few prosecutions followed the collapse. The system had been authorized through parliamentary process. The system allowed aggressive promotion within legal boundaries. The infrastructure that survived eventually generated real economic benefit. The speculative overlay produced uneven financial consequences. Railway Mania demonstrated how information asymmetry shapes profit distribution. The structure did not eliminate winners. It concentrated them at the beginning of the cycle.
The financial crisis of 1847 exposed weaknesses in Britain's railway expansion model. Parliamentary authorization had not guaranteed economic viability. After the collapse, scrutiny of financial promotion increased. Criticism focused on the volume of railway bills approved between 1844 and 1846. Legislators debated whether oversight had been sufficient. The Bank Charter Act suspension in October 1847 highlighted systemic vulnerability. Monetary stabilization became a priority over expansion. Credit conditions tightened for speculative ventures. New railway proposals slowed significantly after 1847. Investors became more cautious in subscribing to fresh issues. Established trunk lines consolidated weaker competitors. Mergers reduced redundant routes over subsequent years. Financial reporting practices improved gradually. Directors faced greater pressure to disclose accurate cost estimates. Engineering surveys became more standardized. Capital requirements were scrutinized more carefully. Speculative subscription without adequate liquidity became less common. However, regulation evolved incrementally rather than abruptly. The state did not prohibit railway investment. Infrastructure development continued under revised financial discipline. Surviving railway companies expanded cautiously into the 1850s. The physical network matured through consolidation rather than rapid proliferation. Lessons were learned unevenly across markets. Speculation did not disappear from British finance. Later decades would witness new investment booms. Capital markets remained susceptible to enthusiasm cycles. Government authorization continued to carry symbolic weight. The distinction between legal approval and financial prudence required reinforcement. Railway Mania influenced subsequent debates about limited liability and corporate governance. Shareholder responsibility for installment payments remained a cautionary example. Banks reassessed exposure to single-sector concentration. Public memory of losses moderated short-term speculation. Yet infrastructure remained politically attractive. The belief in transformative technology persisted. The structure of promotion, approval, and capital subscription survived. The system adapted without eliminating speculative incentive. Railway Mania reshaped oversight but did not remove the underlying dynamics. Railway Mania was not the first speculative bubble in Britain. It was not the last. Its structure followed a repeatable pattern visible in later infrastructure cycles. The narrative began with technological transformation. Railways genuinely altered transport efficiency. They reduced travel time and freight cost across industrial regions. This technological success created credibility. Credibility attracted capital. Capital required legislative approval. Parliamentary authorization provided formal legitimacy. Legitimacy reduced perceived risk among investors. Reduced perceived risk accelerated subscription demand. Subscription structures lowered entry barriers. Installment payments deferred full capital commitment. Rising prices reinforced optimism. Optimism displaced scrutiny. Engineering feasibility became secondary to market momentum. Projected demand replaced verified traffic data. Competition between parallel routes was ignored. Liquidity sustained the illusion. As long as share prices rose, obligations remained manageable. When credit tightened, the structure destabilized. Capital calls exposed overextension. Late participants bore disproportionate losses. Early sellers retained profit. Government endorsement did not prevent collapse. It amplified participation. Infrastructure as a public good created persuasive justification. The language of national progress masked financial fragility. Technological transformation and financial speculation became intertwined. The railway network that survived reshaped Britain permanently. The financial losses reshaped investor behavior temporarily. Infrastructure changes the economy. Speculation changes capital allocation. When political approval, technological optimism, and installment finance combine, systemic risk increases. Railway Mania demonstrated that infrastructure can be both productive and destabilizing. The technology endured. The bubble did not. The pattern remains repeatable.